Hello, PFXers, and welcome to the podcast for Monday, the 30th of June, which actually takes us right into the first week of July, which is always an interesting week for a couple of reasons. I expect we'll probably get some aimless trading, but there is some data that we need to be aware of. And we actually start this, at least in North America, Monday evening with the Tankan survey in Japan. So we're going to be watching this one very closely because this particular pair very closely for a couple of reasons. The first is, of course, we get an important manufacturer's reading on Monday. We're going to be interested in what happens there. Could be disruptive to this new trend just beginning to peel off of resistance. If we zoom out here a little bit, you can see we just came right off of this big decline in March, this big price shock we had in March. Well, are we going to be able to break through the levels here, the consolidation that was occurring here in May and June? I don't know. I don't know. This is going to be a toughie. The market was stopped here. Are we going to break down below 105.50? Some of this may actually depend on the Tankan survey. Obviously, we're creeping up on that level. More than that, though, it's going to really depend on equities. Are equities going to strengthen, or are they going to continue to stay really weak? We got a really big price shock on Thursday. Traders, to a certain extent, may have actually been preparing for this week, which we're going to talk about in a minute. So that is likely to have a much bigger impact, a much bigger play here on the dollar yen. I'm going to be waiting for a breakdown below this resistance level 105.50 before I get too serious about dollar yen shorts. Or if I was already short, I would definitely be keeping those hedges on until we're cleared this resistance range right in here, this consolidation in April. All right, let's jump to Tuesday. We actually do get some interesting data on Tuesday. Definitely interesting to a lot of us who have been long the Aussie dollar for quite a while. We get one of the reasons why a lot of us are long the Aussie dollar is because we're taking advantage of that big cash rate. So right now we have a rate currently from the Reserve Bank of Australia of 7.25%. Are they going to reduce that? Probably not. Are they going to raise it? I think that's also unlikely. Traders are going to be much more interested in what's the rate statement that comes out with it. We've already bounced off of resistance here at the end of the week, and we're stuck within this consolidation range occurring in May and June. Which, hey, that happens to this particular pair. Very responsive to support and resistance levels. We're going to be watching this one very closely for disruption that may occur from that rate statement. If you're in North America, this happens very early in the morning, so you want to watch that one closely. A little bit later in the morning, we get retail sales. Now, I've actually plotted the last couple of retail sales reports here, whether they were above expectations or below expectations. One thing that I've noticed, if you look over the long term with a year's worth of retail sales numbers on the commodity currencies, if it comes out in favor of the prevailing trend, there's a very high probability of a continuation of that trend, which in this case is to the upside. So I'm going to be watching that one very closely. Right now, estimates are coming in for something for negative growth, very mild negative growth. So we'll see if we get a positive number on that retail sales number. We may see a nice upside potential here into the 97s, even the low 98s. Now I'm shifting gears here just a little bit as we take a look at the euro-US dollar. The dollar obviously losing a lot of ground to the euro right after the announcement from the FOMC. As well as the decline in equities, etc. We really weighed down on the dollar. There are a couple of announcements this week that could add to that volatility, but I would suggest applying a benchmark metric to this particular report. Specifically, I'm talking about the labor report. And on Wednesday, we get the ADP teaser or spoiler, depending on how accurate it is, for the normal first week of the month non-farms payroll report in the U.S. Now, one thing that I would suggest, however, this report has so many statistical sampling problems that I don't take it too seriously unless we get something that is outside of the range of, let's say, 100K to the upside or even a negative 100K to the downside, meaning jobs added or subtracted from the economy. So if we get somewhere in the middle, I would suspect that the announcement will be absorbed within normal volatility. But we will want to watch it. Additionally, something that we need to be aware of on Wednesday is that we're starting to creep into the end of the week, and in this case, we're talking about a holiday week. Friday's a holiday in the U.S. It's Independence Day. Everything's going to be closed. Traders are going to be out on a long weekend. So we're getting into that holiday volatility. We're going to want to watch this one. If we get a surprise with outside of that neutral range, if you will, that's where I would suspect we may get a little disruption to the trend here, and we may not be able to exceed the upside potential here. I would say 160 is our near-term resistance level. This may be one of the catalysts that turns it back. Also on Wednesday, we do get a report. We do get trade data, rather, from Australia. So we're going to be wanting to watch that one as well. If we're still consolidating within this range, which may be the case, that could be a catalyst to either push us out or push it down. We'll want to be watching that one. If you're in long positions there and we get a really bad trade data, so a big deficit there, particularly in light of energy costs, etc., that may be something that you'll want to hedge against happening on Wednesday this week. Now we're back looking at the U.S. dollar to finish out the week on Thursday. There's two things happening on Thursday we're going to want to watch very closely. Definitely concentrated. The impact will be concentrated on the euro-U.S. dollar currency pair. We get the interest rate announcement from the ECB, 4% right now. It's too early to say whether what the likelihood is for a rate hike. We're going to have to watch this during the week because things are definitely in flux, and the reaction on the dollar here this last week is probably going to play here. So we're going to want to watch this and then make some estimates as we get closer to Thursday as to whether or not we see 4.25%. In addition to that, Friday's non-farm payrolls report, the official one, not the ADP one, is being pushed up to Thursday because Friday is a holiday. We're going to want to watch this because these announcements come out in the morning in North America, so very early, and then we're likely to see a real drop-off in trader activity through Thursday. So Thursday next week, I suspect, will be very much like a normal Friday, actually, as traders head out for the weekend. In North America, that's gonna make a big dent in the trading activity in general globally, and I don't suspect that we'll see much more than some aimless trending towards the very end of the week into late Thursday and Friday through to the close. So most of the impact is we're probably going to feel it very early with the 1-2 punch of the ECB coming out, 4 to 4.25%, and the unemployment rate could see a disruption to this particular trend. I'm going to be especially concerned if we're all the way up here to the 1.6 level. Just about any cracks in either the outlook from the ECB or some positive news from in the non-farms payroll report. If we've got prices up here at 160, we could definitely see a turnaround and some downside potential. That may be an exit for euro dollar longs or just an opportunity to tighten up some of those stops and risk control.